Welcome back. I'm Denise Williams, and I am here with Rachel Kuru, Assistant Vice President of Investments at Mayberry Investments. Welcome.
Thank you for having me.
All right. Now we're going to talk about a topic that may not be, always all over the place, but it's important because the bond market is 3 times the size of the global stock market. That's huge.
Yep.
Okay. And there's a ton of opportunity for you to pick and choose the type of bond that works for your cash flow needs, because we're all about helping you find another source of income. So Rachel is going to take us through the world of bonds. So we want to really get the ball rolling in understanding what is a bond. I always encourage you, get your pen and paper ready, because when you take notes, you can speak with confidence to your banker. All right, so I'm going to make some statements and you tell me if I'm correct or not. You can correct me on air, put me in the right direction. It's okay.
I'll work with you.
Okay, all right. So bonds represent a loan from me, the buyer, to you, the seller. Yes, no, maybe?
Correct.
Correct? Awesome. Okay. Bonds can be issued by companies or governments. Yes or no?
Correct.
Okay, so I'm on a roll. Usually bonds pay a stated interest rate, so you know how much interest you're earning every period.
Absolutely.
Boy, I tell you, I think I've done this before. All right. And bonds are a way for an organization to raise money to do something.
Correct.
So in your experience, what do companies raise money to do? Give me some ideas.
Sure. It can be raising money for general working capital support, capital expenditure. They need to expand.
Right, like buy a building.
Buy a building or buy some machinery. So they'll take out a bond where they'll go and they'll ask investors, hey, I have a great company. I want to expand. I want to borrow some money from you. I will pay you back at an agreed interest rate for an agreed time.
So why not just use my credit card?
No.
No?
Because what you're paying back the bank, the interest rate you're paying the banks you're not going to earn enough on the bond to cover.
Meaning like if I was a company, why can't I just use my credit card and buy the machine?
No, because the bonds, they're offering you, when you raise money in the capital market, it's allowing the company and the investors to agree on an attractive interest rates. The banks are going to stick you up.
Okay.
So it's a win-win for both parties.
And I love that. A win-win. Investors win, companies win. All right. Now, there are 2 ways to make money in bonds. So if I'm the investor, the first way is to hold the bond until they mature. So that's when I get back my money.
Correct.
Now, the other way is to collect periodic payments. So again, walk me through how that works in your experience.
Okay, so as you said, you're going to earn money at regular intervals, quarterly, monthly, semi-annually, whichever you agree at the time. And you're going to get back your money at maturity, but you need to reinvest your funds. So whatever money you're getting back at a regular interval, you need to ensure that you're reinvesting it.
Yes.
So every quarter, for example, you're getting back money from the company. You need to go now reinvest that money so you can earn compounding returns.
So I'm earning on my earning.
You're earning on your earning.
And that's how I am. I have a job, I have a 9 to 5, or I have a business. But you're saying when I invest, I earn on top of my earnings. Usually I eat my salary.
Oh, yes.
Usually when I have a business, I have to pay my staff and pay the rent. I don't really keep much. You're saying when I invest, keep what I invest.
You need to keep what you invest. I mean, you can treat yourself here and there, but my recommendation is to go and reinvest your funds. You're maximizing your returns right now, and we're in a high interest rate environment, so you want to capitalize on earning and maximizing your returns.
Okay, so Rachel, the company you work for, Mayberry Investments, they've been around a little while, well, like 30-something?
39 years.
39 years. Okay, so I think you kind of know what you're doing, and the company kind of know, All right, so we want, we're drilling down and we're repeating this concept of passive income. Tell me what's happening in this world. You know, we're using bonds as a tool, an investment tool to buy bonds. So if we're saying to everybody, listen, take out your pen and pencil and your pen and your crayon and your paper, something, and you're going to take what Rachel says to your banker, and you're going to say, I want this. What are we doing right now to get some passive income?
Okay, so I think we need to first explain that passive income is one of the easiest ways to make money at minimal efforts.
Okay.
And as you said, the fixed income securities, bonds, provide a perfect opportunity to make money effortlessly.
Okay.
So my recommendation now is, you know, investors need to go to their investment advisors and tell them, hey, I want to earn some passive income, and Rachel recommended investing in the MJE bonds.
Okay.
Here they're going to earn interest rates they're going to earn attractive interest rates. We're paying up to 10.5% per annum in interest rates, and here you're guaranteeing fixed payments. The rates are fixed, you're locked in. Also, the rates are tax-free, so that interest amount goes straight in your pocket. It's not taxed.
Oh, really?
At source, yeah.
Oh, I didn't know it's tax-free.
So it's a perfect way to earn stable, reliable income at attractive returns.
All right. So now, I'm glad you said attractive returns, because we're in a high inflation, high interest rate regime. How are you guiding clients to know what is attractive? Because you made you use up the phrase attractive. How do you know what's attractive?
Okay, so in the bond world, you know, we're looking for different features in a bond.
Yes.
The first one we're going to look at is the company. The company a good company? You know, is it worth investing in? Are you sure they're going to pay you back your money at the end?
That's important.
After that, we're going to look at, you know, the offering that they're coming out the bond. What's the interest rate they're paying? Is it attractive? You know, is it over inflation? At a minimum, inflation is now at 6% thereabout. You need to look at the interest rate. You know, are they offering you attractive interest rate? Is this worth my while?
Yes.
So we're going to look at the interest rates offered on the bonds.
Right.
We're going to look at the tenure of the bond. It makes no sense for you to invest your money for 30 years.
Okay,
You know,
right,
so,
30 years.
So, you know, we all have different investment horizons, so we need
Right.
to ensure that the tenures match our investment horizon. So we need to zone in on the tenure. So we're looking at the interest rates. We're going to look at the tenures of the bond. We're going to look at, is the bond secured? Security it's a real thing. It's a real thing.
You know, I tell you, it's security.
Yeah.
I know it's something we ladies like. I don't know if all investors like security, but we ladies like to be secure.
Agreed.
And I want my money secure.
Agreed.
Yeah,
So, you know, so you have to look at the security package, you know. If the company should go bust or, you know, in a technical default, you know, is there enough collateral put aside so I can ensure I'm going to get back my money?
Because that hurts, you know.
Yeah.
It hurts when you don't get back your money.
It really does. It really does.
Let's flow into our next question, because if you are at retirement age or you're nearing retirement, you cannot start over.
Yeah, so as a retired person or retiring person, you need to focus on three things. You need to focus on reliable income.
Yes.
Low risk investments
Right.
and investment that are going to preserve your capital. That's very important, capital preservation. So you need to focus on those things. And again, bonds, they provide an excellent way for you to earn stable cash flows, and you are guaranteeing your money at the end of the day.
Okay.
So, you know, they're going to explain a little bit, you know, stable income in the form of fixed quarterly or semi-annual
So
interest
that's
payments.
every 3 months
or
every 6 months.
You're getting money in your pocket.
Right.
And also you're getting back your money at the end of the day.
Right.
At the maturity, you're getting it back. So as a retired person, that's a conservative way to earn some reliable income.
Okay, I got a big one for you. You ready? Okay. Bond ladder. I want to create a bond ladder because I don't want to do every 3 months, every 6 months. I want some money every month. How can I do this? Again, we're taking pen and paper. We're taking instructions because we're going to go to our banker and say we want this. Tell me about the bond ladder. How do we create one?
Okay, so a bond ladder strategy is investing in a series of bonds with different maturities, as you mentioned. So this way you are ensuring that you have reliable income at fixed intervals.
Right.
Oftentimes it's annually, not monthly, but annually.
Yes.
And the MJE bonds, they actually provide a perfect opportunity to capitalize on this strategy.
So we're doing different bonds at different times so that I can get to close as possible to a monthly check.
Correct.
And you're saying if you structure your bond at 13 months.
Correct. So we have 3 tranches, we call them in this world.
Yeah, the world of bond, we use tranches, we use timeline, we use the big French word, tranche.
So we have 3 tranches, one for 13 months, one for 26 months, and one for 36 months. And the beauty of it is each tranche has different interest rates. So the 13 months has 9.25%, the 26 months has 10%, and the 36 months has 10.5%, and these are all tax-free.
I love it. So my bond ladder can have 3 different time periods using the tranches.
The tranches.
And not only does it have 3 different time periods or tranches, it also has 3 different interest rates. And it's tax-free. So I keep all my money.
Yeah. Everything goes straight in your pocket.
Oh, boy, I tell you. But okay, fine. And I love it because now we're getting checks. And I think we love checks to go into our deposit into our accounts or, you know, allow us to reinvest because we're earning on our earning.
Compounding returns.
Okay, but let's go back to, you know, you touched briefly on people being afraid of not getting their money back, but people are also afraid of the stock market. So let's just talk about, you know, in your view, let's look at the next 3 years quickly to see, you know, the fear of investing and what are you going to miss out if you give in to the fear.
Okay. So you mentioned a lot of persons are scared of the stock market, especially females. You know, we're very risk averse. So I was guilty of that as well.
Okay.
But here at Mayberry, we love the stock market. We believe in the Jamaica stock market. We've been investing for over 39 years, as you mentioned. Yeah, a little time. But we have all confidence in the stock market. We believe the stock market is going to rebound pretty soon.
Okay.
You know, there are macroeconomics at play, macroeconomic conditions at play, but we are seeing some market indicators that suggest the market is going to turn around early next year. You know, we're seeing where interest rates are going to start trending down and inflation is now within the central bank's target range. I believe the point-to-point inflationary rate last month was 5.3%, and the bank has a 4 to 6 target window. So, you know, there are signals in the market that are suggesting that it's going to come back.
So you're saying to me, here's what I'm hearing. I'm hearing that you believe in the stock market. You believe that there's signals that the stock market it's kind of low right now, but it may go up. So when it goes up, your money goes up with it. And interest rates may come down. So if interest rates come down and you locked in for 36 months, you may actually be earning a higher interest than everybody else.
Correct, you'll be above the curve.
You'll be above the curve. But not only that, when you get your money, your interest payment from the bond, you could actually take that cash, drop it into the stock market, and ride the wave up.
Agreed, because reinvesting your funds is the best way to maximize your earnings. So if you invest in our bonds and you get that check every quarter, now is the time, you know, take that bit of interest, invest it in the stock market. It's going to go up, it's going to rebound. So you want to get in from now. So that would be my recommendation, you know, diversify your portfolio.
Right, so that's us looking down 3 years down the road. Okay. All right. So large institutional investors, we don't want to leave them out. We talked about, you know, retail. They borrow to invest. So that's what the big guys are doing. The big boys, they borrow to invest. We talked about that earlier. You know, you don't take out your credit card. They let investors win. That's what the big guys do. What about me? Can I borrow to invest?
You can borrow to invest, but you know, I'd encourage investors to, you know, seek professional advice. When it comes to it, you know, leveraging your portfolio, what we call it, it has excellent potential gains. But we need to understand there's some risk associated with it. So my advice would be to reach out to your advisor, assess your risk tolerance, and you can determine if leveraging your portfolio is the best way for you to go.
You know, there's a young lady I know, I won't call her name. I asked her this morning why she doesn't invest in the stock market, why she doesn't invest, and she says she can't stand losing. So I think you need to talk to her.
Absolutely. I wonder if this lady's in the room.
I don't know.
But my advice to her would be, as an investor, you need to focus on 3 things. Diversification, that's very important. You need to try and invest in as much asset classes as possible. Bonds, stocks, real estate. You know, here you're hedging your risk, and that's really important. My second advice would be to implement what we call dollar cost averaging. You know, you're going to have to pick an interval where you're going to continuously pump money into your investments.
Yes.
You know, this way you are minimizing volatility that's present in the market.
Right.
And you're also, you know, minimizing the timing of the market. You know, the pitfalls when you don't get to, you know, capitalize on that perfect timing.
Right.
So when you're investing at, you know, set horizons, set intervals, you're eliminating that.
I like that. So dollar cost averaging, and I'm not going to call the young lady's name, although she may be on the set. Dollar cost averaging is when you say, I'm going to, every month.
Or quarter.
Every 3 months, I'm going to put $1 in the stock, in the bond, in the investment that I like, so that the up and down of the market doesn't impact me, because I only put a set amount in.
Correct.
So I can sleep at night.
Correct. And with that strategy, you know, sometimes you may be on the curve, you may, you know, you're not timing it properly.
Right, so you may buy at the top.
Yeah, but then you're averaging down.
You
so
buy at the bottom, and then you're up and
so you're averaging down. So you're creating that at the average.
So, wow. Please write that down.
And there's one more.
Oh, one more. So dollar cost averaging, one more.
Yeah, and there's one more for her. She needs to focus on long-term investments.
Long-term.
So she needs to pick an investment horizon.
Yeah.
She needs to buy quality investments and just hold it for the long term.
Yeah, it's almost like farming. You put the seed in the ground. You don't dig it up right away.
Exactly. So, you know, whether it's 3 years or 5 years, you know, she just finds some good quality investments. She invests and she ignores the short-term fluctuations.
Right.
You know, 6 months, oh, it gone down. No, because your goal is 3 years.
Absolutely.
So you're going to just ignore the short-term fluctuations. So that would be my advice.
Wow, that was a lot. We deep dived into the world of bonds. This is another source of income. So I trust you are taking notes so that you are ready to go to your banker. And just to be clear, let's run through how you buy bonds when you're ready. Number 1, you will open an account with your broker. The second thing you will do is place your order. Everybody's reading your mind. You've got to give the investment firm instructions to buy or sell. And you can do this in person or by phone or online. This is called placing your order. So you're going to tell the investment firm the name of the bond and the amount of the bond you want. So let's just quickly summarize our journey with investment in bonds. You can make money on a bond from interest payments, and you can make money on a bond by selling it for more than you paid. You can lose money on a bond if you sell it for less or if the issuer defaults on their payments. So it is super critical that you check the quality of the company and the bond that you're buying. When you buy or sell a bond, the commission is built into its price, and the investment firm marks up the price of the bond slightly to cover the cost of selling the bond. But, you know, all of that said, we're back to the point. You can use the bond as an excellent source of passive income. So, thank you so much, Rachel.
Thank you for having
taking
me.
the time to explain the bonds. I'm Denise Williams. I'm your host. I'm going to encourage you to visit our website, www.financiallyfocusedmedia.com. Take advantage of our free financial independence course. I will see you next time.